stocks have been swinging all over the place this morning as higher bond rates continue to unsettle equities. Now, look at the triple stack. And the Nasdaq's been all over the place. It was down and it's now settled in the green. The big board is down and it's stayed down, but it is off the low numbers. US lawmakers are moving forward with President's $1.9 trillion stimulus package. The House is voting to pass and it'll pass along party lines, so it'll get past the House. However, the Senate will be a much different affair. And the combination of new federal spending and widespread vaccinations is leading to the possibility of supercharging economic growth this year. Just look at the sort of things we're talking about. Personal income's already up 10% in January, thanks to the last round of stimulus checks. And there's more coming if the stimulus plan is passed. The next bill would send $1,400 to people making less than $75,000 a year. Increase federal unemployment benefits by $400 a week for the considerably longer period, and that would last until late August. But it's unlikely that the minimum wage will get through. President Patrick Harker is president of the Philadelphia Fed, joins us now. President, good to see you, sir. Thank you. And I just wonder, when the markets, and this isn't just sort of, the markets are up, the dollar's up, the bonds are down or whatever. The markets are sending a message. The bond market is sending a message. What are you hearing from that message?
So again, I need to look through any given day and any given movement in the market to medium to longer term trends. I do think the market is sending a signal in our world that they are expecting higher inflation at some point. We don't see that right now. We don't see inflation running out of control, but we do want inflation to rise above our 2% target. That's our new monetary policy framework. So the fact that we see inflation rising, but still under control, is a good sign, not a bad sign.
In that, I mean, you're fine-tuning inflation with a bulldozer and a blunderbuss of a weapon, which is this vast stimulus package, which some reputable economists think is too much. Others think it's not enough. Where do you stand on the $1.9 trillion?
So that is in the hands of the administration and Congress. I can tell you what we're assuming as opposed to what we want. In our forecast going forward, we're looking at growth in the first half of this year, a little above 3%. The second half of the year, above 5%, to average in the 4-ish range. And that's a good outcome. And we're assuming in that forecast a $900 billion stimulus package, especially that it is designated and really targeted to the people who need the money the most. So again, I'll leave it in the hands of Congress and administration about what that package is. But we do need some stimulus right now. We're assuming around $900 billion.
Right, $900 billion. Now, listen to what Christine Lagarde told me last week, the president of the ECB, on this relationship between monetary and fiscal. This is President Lagarde.
Fiscal and monetary did not work so well together back in 2008 or 2011 in Europe. And very often you heard the central bank governors saying, it cannot just be about monetary policy. We are not the only game in town. You don't hear that anymore, because both on the fiscal front and on the monetary front, policies are working hand in hand and are really laying the ground for recovery to take hold after we are done with that period where economies have switched off.
Now, Chair Powell said on numerous occasions last year to the fiscal side that more needs to be done by that side. Are you happy? Well, happy is a strong word, but you know what I mean, for bankers, for monetary bankers. Are you content with the environment now between monetary and fiscal?
So I think there's a set of short-run issues. Again, we need to get through this pandemic. We need to get the vaccines into arms. We need to do what we can. And in my view, change the fewest things we can right now so that we can get through this period. As we start to climb out of this pandemic, the goal is to get back to where we were before the pandemic. That's very hard for people to remember, but we had a very good labor market. We had a good economy going. We need to get back to that, but frankly, better than we were before, especially for those who were left behind in the recovery from the Great Recession. So, yeah, I think things are working okay right now. There are a lot of longer-term issues we need to address, in particular to try to close the opportunity gaps that exist for workers in America.
How can you do that? I worry that, you know, this opportunity gap. You've got your new occupational mobility explorer to try and match people up. But there are some reports that suggest unemployment by year's end could be back down again at 4% if this economy roars ahead as expected. Now, if that's the case, Mr. President, then you've got full employment.
So we are looking at unemployment probably a little more than 5%. That's our forecast right now. For some, you're right, have it at 4%. But again, go back to where we were before the recession. Even though the economy was good, there were lots of people left behind, and the wealth and income gap kept growing. And we know that over time, if that gap gets wider and wider and wider, economies slow down. You see this throughout economic history, right? You see this in the worst case when there's this great disparity between the rich and the poor. So we need to help people get those jobs, upskill those jobs, and get rid of the barriers, because there are lots of barriers beyond skills. Low opportunity does not mean low skill. There are other reasons, you know, housing, transportation, childcare, that it really inhibit people getting the kind of job they need to sustain themselves and their family. That's what this opportunity, occupational mobility explorer, is all about.
The problem is, as we went into COVID, we were only just starting to grapple with the potential. Look, you've seen the reports, up to 40% of the blue-collar workforce could be out of a job as a result of AI and technological changes. Now, that risk hasn't gone away. And I question the ability of policymakers to not only go back to deal with that, but also the enhanced risk post-COVID.
So our job at the Fed, in addition to monetary policy, through our community development function, is really to lay out the facts, right? To lay out the opportunities and the problems as we see them. And so you're right, there are a lot of jobs that are going to go away, but there are new jobs being created each and every day. I'll give you one example. We saw this before the pandemic. We even see it now. And this is part of this occupational mobility explorer. You can go in there, see by 33 metro areas in the country where the jobs are, where you can upskill, and what kind of salary increase you would see. Let me just give you two quick examples. Say you're in Cleveland and you're a maintenance worker. You could upskill into a truck mechanic or an HVAC mechanic, and you'd see an average increase in salary of 22%. Or say you're a bill collector in Philadelphia. With some training, you could become a credit counselor, and there are jobs in credit counseling with an average increase in salary of 45%. So both on the blue collar and the white collar realms, there are opportunities for people to get better jobs, life-sustaining, family-sustaining jobs.
President Harker, thank you, sir. Have a good weekend and keep well. We'll talk again as the year moves on, because this is a fascinating aspect, this idea of job mobility and occupational training.